From Hotspotting. The SQM Research Weekly Report on Prices was published yesterday and broadly confirms the information published on Friday last week by CoreLogic. And the key message in both reports is that property prices in the past month have held up remarkably well. The CoreLogic report recorded growth in the house markets of 6 of the 8 capital cities and 6 of the 7 regional market jurisdictions. The SQM figures published yesterday have similar outcomes. The SQM weekly reports have indexes for price movements in the past week, the past month, and over the past 12 months. And according to this week's SQM report, in Sydney, the house price index is up weekly, monthly, and annually. In Melbourne, the house price index is up weekly, monthly, and annually, and Melbourne apartments the same. In Brisbane, the house price index is up weekly and annually, but down monthly, while Brisbane apartments are up in all 3 categories, weekly, monthly, and annually. In Adelaide, the house price index is also up in all 3 categories, and Adelaide apartments the same. So you can see the trend. Nationally, both the house price index and the units pricing index is up for the past week, the past month, and the past year, and the capital city average is the same. So again, it's a very strong performance by prices around the country. Now, some sections of news media continue to dismiss these results as somehow irrelevant, but when you consider that we've been in the midst of this virus crisis for around 3 months, the performance of residential property prices across Australia has been remarkable. Now, one of the factors that will be important in terms of maintaining property values as we go forward will be the level of supply in the market. Demand from buyers has fallen, but so too has the number of properties for sale. Many vendors have been reluctant to sell in this climate, so listings of homes for sale have dropped. And this week, SQM Research also published its latest data on the number of homes on the market compared to the previous month and also compared to the same time last year. Nationally, the number of homes for sale has decreased 12% compared to the same time last year. In Sydney, listings are down almost 20%, while in Perth, Darwin and Hobart, they've dropped 16 to 17%. There's also been a notable drop-off in the number of homes for sale compared to last month. So while there are fewer buyers out there in the market, sellers are scarce as well, which means there is some kind of balance between supply and demand, which is a factor in keeping price levels solid despite everything that's going on. Now, another factor keeping markets fairly solid is that coming into the virus crisis, markets were strong and the buying intentions of Australians generally were very solid. A new research report from one of the world's largest banks has revealed that a record number of Australians had been planning to buy a new home before the COVID-19 pandemic hit. Nearly 1/3 of those people surveyed had been considered upgrading, downsizing, shifting location, or getting into the property market for the first time, according to Rabobank, in what would have been a massive boost for the economy. And it's been suggested that if potential purchasers aren't too adversely affected by the coronavirus crisis, now could be an excellent time to consider with those plans, with fewer competitive buyers in the market, interest rates low, and dissatisfaction with current homes rising as a result of prolonged isolation time spent in them, apparently. Glenn Whelans of Rabobank says the bank has been conducting its financial health barometer of the country for over a decade, and he says, in the poll we conducted in the first quarter of 2020, we found a record high number of Australians, 29%, citing the intention to buy a new home in the next 2 years. That eclipsed the previous high of 24% in 2016, when house prices went up by 15%. And as we start to return to some kind of normal, those buying intentions may be a factor in driving recovery. Now, looking at the overall shape of the economy, Macquarie Group Chief Executive Shemara Wikramanayake says Australia's economy is well positioned to get through the coronavirus in the longer term. She cites government support, links to Asia, and a recent flurry of capital raisings by big business. Speaking to investors via a webcast yesterday, Wikramanayake said the world economy faced a recession, but fundamental forces such as technological change and urbanisation would re-emerge as longer-term drivers of growth after the crisis passed. She cited another reasons as to why the investment banking giant believes Australia's economy should weather the crisis better than most countries. These included the Reserve Bank's extensive stimulus, fiscal support for businesses and households, a relatively strong public balance sheet, linkages to Asia, and a big pipeline of infrastructure investment. Now, it's considered reasonable that the vast majority of Australian businesses could be up and running again in less than 2 months, following the National Cabinet approval of a comprehensive set of health protocols to enable commerce to resume in a COVID-safe environment. Declaring we now need to get 1 million Australians back to work, Prime Minister Scott Morrison and the state and territory leaders agreed yesterday that when they next meet on Friday, they will lift restrictions in 3 steps with the aim of establishing a sustainable COVID-19 safe economy in July. Each state will move at its own pace with a common goal of getting back to normal by July. While not every business will be able to reopen, such as those that rely on international tourism, Morrison says the aim is to have the overwhelming majority back on their feet. Meanwhile, Reserve Bank Governor Philip Lowe has flagged a stronger than expected economic recovery if Australia's successful containment of the coronavirus allows more businesses to reopen earlier, which now seems likely. After keeping rates on hold at a record 0.25% at its monthly board meeting yesterday, Lowe said several scenarios for the economy had been considered and will be detailed in the Statement of Monetary Policy to be released on Friday this week. The Reserve Bank's central scenarios for economic growth to fall by about 6% over this year before returning to growth next year. Unemployment, it says, should peak at around 10%, but will be back down to around 7% by the end of the year. So with each passing day, the situation looks better and brighter, and we're looking forward to getting back to some kind of normal pretty soon. Bye for now. We'll speak again soon.